We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Kao. He's a former hedge fund manager and commodities trader and private family office investor, and also the author of Cowboy Musings on Substack. How are you today, Michael? Thanks for joining me.
Awesome. Great to be back with you, Tom.
Absolutely. It's, we never have a lack of things to talk about, and I really appreciate getting your perspective because, as I was saying to you before we hit record here, I really like the idea of, or I find a lot of value in the secondary and tertiary effects of a lot of these decisions that are being made, a lot of these chess pieces that are moving around. So I'd like to cover just quickly your thoughts on the FOMC meeting this week. I thought it was interesting that the real question that they're wrestling with was if they're restrictive enough right now. So was it a surprise to you to hear that despite not hiking this month?
No, so I'll tell you what I got right and what I got wrong. So like early in the day yesterday, I basically said, look, I think what's going to happen is that we're going to rally up until probably a half hour, 40 minutes into his presser, and rally based on, this I guess this surprise announcement that from the quarterly refunding announcement that there would be less duration being offered, and that's somewhat supportive of bond prices and therefore risk assets, right? I thought that we would rally based on that, but then I expected Powell to say exactly what he wound up saying, which is that the higher for longer situation. And the key comment that I picked up on was his comment that, despite being repeatedly asked about, what do you think about rate cuts next year? And he basically said, look, we're not even thinking about that at this point. In fact, the primary question that we're still wrestling with is whether we're restrictive enough. Mm-hmm. And so I thought the market would stop rallying after hearing that and then sell off. And of course, what happened was exactly the opposite. We wound up ripping into the close, and then the rip has continued today, right? Mm-hmm. So it's all kind of very interesting and a reminder how humbling the market can be. So like for me, I've been I'm essentially market neutral right now because I have idiosyncratic longs that have done very, very well this week. But of course, I also have on macro hedges. And I think I mentioned yesterday on a different podcast that I do think even though I think I'm on the macro side of things, my bearish bets look like they're wrong right now. Mm-hmm. I think that the market hasn't fully digested what, as you say, the secondary tertiary effects of what truly higher for longer means, because higher for longer, we've already been for the last 2 years. I've thought that we would be higher for longer, and it was for that reason that, at least for myself, right, in terms of the yield curve, I never extended beyond the 1 year point. I always favored short duration and kept rolling short duration. Mm-hmm. And so I was able to dodge the calamitous bear steepener on the long end of things. But the fact that this has not materialized in a serious risk off in equities is because of this I think primarily this fiscal tailwind that is partially from the leftover effects of all of the COVID spending, but buttressed by forward-looking effects of the 3 different bills that this administration has passed, right? Between the bipartisan infrastructure bill, the CHIPS Act, and the ironically named Inflation Reduction Act, we're talking a cumulative $2 trillion of spending. Mm-hmm. I love the vodka Red Bull analogy, right? Because the Fed is trying very hard and I actually think not hard enough to administer the depressant, and the other branches of government are pouring stimulants. And so that creates a very interesting dynamic, because it's a dynamic that the rest of the world doesn't share. Okay. I wrote a thread a couple months ago called "The Four Horsemen of U.S. Economic Resilience," and just really briefly, right? Those four horsemen are the structural and demographic reasons for shelter and inflation and labor stickiness. Shelter and labor inflation stickiness here in the U.S. Now, some of those factors are shared by some of the Western European economies. Okay. But what's clearly not shared is the second horseman, the biggest horseman of all, which is this fiscal tailwind that we just talked about. The third one that's definitely not shared by the rest of the world is that the U.S. consumer, homeowner, as well as the U.S. corporation, is far less sensitive to floating rate risk. And then the fourth, of course, is relative U.S. energy independence. That definitely is not shared by, definitely not Asia, not the economies of Japan and China, and largely not continental Europe either. So what that portends to me is that the Fed is going to stay higher for much longer than what people think. And then the secondary and tertiary effect of that will be that it will be it won't be ultimately good for long duration assets of any ilk, whether you're talking about fixed income instruments or equity instruments. And it still favors being weighted towards current cash flow versus what I call terminal value plays.
So, Mike, there's a lot to kind of pull on there, but you mentioned one of the really interesting points that we've seen, and in some ways has gone kind of unnoticed. And I wanted to get your take on the idea of all of these new salary negotiations being introduced into the market, and if that kind of ends up being the next leg for inflation, creating a wage price spiral effect to really spur inflation higher, to your point, against kind of working against the Fed's restrictive higher for longer stance here to try and control inflation.
Yeah, 100%. Because look, I've actually been harping on exactly this issue the last several weeks, and I noted the conspicuous absence of any sort of commentary by the Fed heads over the last two FOMC meetings about these spreading strikes. Because initially, right, when the strikes were just relegated to Hollywood, it was kind of idiosyncratic, because I would argue that wasn't a strike that was based upon cost of living pressures. It was more based upon the streaming dynamics creating unfair outcomes for writers, directors, et cetera, versus the traditional model, right? But the thing is, though, between these strikes having their intended effect of kind of like sticking it to the corporate man, if you will, and real cost of living pressures, these strikes have jumped industries, right? And autos, and in some cases, autos, airlines, healthcare. The airlines notably, so autos, it looks like the UAW is basically locking in these 25% wage increases, which are structural. Which are structural. They're not going to get undone. And then, but notably, in airlines, for instance, a lot of these unions didn't actually strike, but they wrested 40% wage concessions even without striking, right? So you got to think that any unionized industry out there is being galvanized by this, and everybody's doing it. And I have been voicing the very unpopular opinion that I think the Fed is kind of playing the sort of transitory card again by pausing the last two FOMCs, because I really think that, the scary thing that I also alluded to yesterday, and we can talk about, is that when you study the sequence of hikes and bear steepeners and ultimately bull steepeners from the 79 to 82 period, right? You basically saw what was very similar to what happened now, where first they were too slow to act, right? So inflation caught fire, and then they hiked, rather aggressively. And then with each hike, there was a stair-step effect. The hike happened, yield curve was sort of inverted, but then the bear steepener happened and brought up the long end. They hiked again, and it happened again. They hiked again, and it happened again. That happened in 79, 80, and 81. But what's crazy is that by 1982, okay, the zeitgeist had already been infected with this notion that inflation expectations inflation expectations were embedded into the economy and into the zeitgeist of the market. So by the time recession actually hit and the Fed actually eased up on the front end, the long end blew out. So I think it's a mistake that the Fed is making by pausing. I think the Fed needed to really kind of cause recessionary conditions and put the skids on this inflation. But I said yesterday, I think that Powell is kind of making an Arthur Burns type of mistake here by pausing. Of course, they're saying we're going to respect the lag and blah blah blah, and look, but just look at the market reaction to this, right? I think these market reactions are ultimately easing for financial conditions, and will wind up becoming self-defeating.
Well, and it's interesting to try and consider exactly as you put it, the article that you wrote about the four horsemen. You have on one hand the Fed trying to be restrictive, yet acting completely orthogonally is the rest of the branches of government really pouring fuel on the fire.
Yes, right.
So
yeah, exactly.
Michael, I find it interesting to think about the idea that, or to really analyze the Fed's verbiage there, right? We're not even thinking about cutting rates, where 2 years ago they weren't thinking about raising rates. So where do we kind of meet in this situation where the market starts to lose faith in the Fed, and how does that start to kind of show itself?
Well, see, the thing is, the market should doubt the Fed if there was a true trade-off, right? And you're definitely seeing some signs of economic slowing, right? You're getting a smattering, right? But for every alarming sign of like the stretched consumer, there's a conflicting signal with like stronger than expected job openings and slower than expected job losses and et cetera, and honestly, the real trade-off between the Fed's dual mandate is just not here yet. So they think that they're approaching that trade-off by pausing clearly the last two cycles, but I would argue that when you've got headline inflation just a shade below 4 after 15 months of hikes or however months it's been now. And the core is still like solidly above 3. I think they're really making a mistake of letting the expectations getting embedded at this point.
So, kind of on the other side of that, I want to get your take on the era that that QE and zero interest rate has really created a situation where, as you put it, long duration risk assets are grossly overpriced. So is this just the new rate environment that makes these valuations untenable?
I think I think equity markets are still clearly being fed by the ZERP animal spirits, right? And the whole notion, I would say that the the recent era of QE, starting around like call it 1998 timeframe till essentially now, that recency bias that stems from that period of policy has created all sorts of I guess thought patterns that are taken for granted. One of them is, okay, well, you know what? If at the first sign of trouble, there's going to be a Fed put, right? The Fed, people were basically, lambasting the Fed for even going above 3%, and of course they would typically be bond managers, real estate managers, and equity managers, right? But the difference between this environment versus this period of, call it 1998 to 2023, is that this entire period the Fed was able to just QE and ZERP out of any recession with no inflationary consequences. And now, with the benefit of 2020 hindsight, we can attribute some of those some of the factors that kept those inflationary pressures in check, right? Namely, because for instance, China's labor force coming into the market and essentially creating a huge deflationary tailwind, counteracting any sort of other inflationary pressures, and also the fact that we never really did the experiment of ZERP plus QE plus MMT as we started doing en masse after COVID. And the crazy thing to me is that even well after COVID, we're still doing the fiscal part of it, right? Mm-hmm. So I think the environment has materially changed, but the zeitgeist with respect to equity multiples is still not changed. And so unfortunately, what that means is for that zeitgeist to change, it's going to be investors need to get kicked in the teeth, right? Yeah. I think you will eventually see that, as you will see eventually higher for longer will create higher defaults, will create slower growth and huge earnings misses across the board. And you will see multiples shrink. So the current multiples, I think, are just nowhere near where they should be in what I think is a more stagflationary backdrop.
Mm-hmm. Yeah, it really seems like we have so many countervailing threads here that are really playing against each other, and it's kind of, as you said, this week, it's difficult to kind of figure out where you want to be long and where you want to be short, just because of all of these really countercurrents in a way. But one thing I'd like to go back over with you is what scares you so much about that bull steepener of the long end of the curve. So where does that come from, and why does that have the effect on the market that it does?
Well, I worry about that because that's the I could see the Fed making the same mistake that the Arthur Burns Fed made, and which is allowing inflation expectations to become embedded, and they're playing this too slowly, in my opinion, especially in light of this fiscal tailwind, right? I mean, if you're seeing what we're all seeing, but you have no choice and no control over the fiscal side of things. Your only lever is to be more aggressively hawkish, and the fact that they have paused is what this market rally is keying off of. But I think looking beyond the immediate effect of this, the secondary and tertiary effect is a true higher for longer environment, which just drags things out in a bad way, right? I think eventually that sledgehammer will work on the economy, but by prolonging things, it will have created a worse dynamic of a sort of stagflationary outcome. I argue that a pure recessionary outcome is better than a stagflationary outcome, right? And so if the Fed acted quickly enough, you could have a recessionary outcome, and then hopefully come out of it. But by prolonging the fix, it becomes a stagflationary outcome, and I think that's far, far worse.
Yeah, that's interesting to think about. It's almost like, taking the hit and getting it over with and being able to rebuild. But
by the way, and it's for that same reason why, like I comment a lot about oil, and I've been saying for months now, for about a year now, that I think that the OPEC cuts that have unilaterally supported the oil market are what I call premature emasculation of ultimately themselves, right? Because it's the same idea, right? So like you're only hindering the Fed's ability here, right? By keeping prices high. And with oil, see, it's interesting because I think of OPEC Plus as the central bank for oil. Our central bank is the Fed is the central bank for dollars. They have one tool. It's monetary policy through adjustment of the Fed funds rate. OPEC Plus has one tool. It's basically limiting or adding to supply of oil. But here's the thing. What the two tools have in common is that they're both ultimately demand destructive. Limiting oil supply and keeping prices high, and raising the Fed funds rate are both ultimately demand destructive. Okay, but what's fucked up about OPEC Plus's tool is that it's both demand destructive and perversely keeps the Fed more hawkish than it otherwise would be if they had just ripped the Band-Aid off, let oil prices collapse, and help the Fed's mission as opposed to go against the Fed's mission. You see what I'm saying? So like ultimately, it's I think it was a short-sighted thing for OPEC to do, and ultimately it's going to be worse for longer-term fundamentals of the oil market, in my opinion.
Well, it's interesting to talk about or to try and consider those two major pieces within the economy that are really counteracting each other. Last time you were on, we spoke about the dollar wrecking ball, and this kind of brings up something I did want to get your take on, and this kind of keys it up perfectly, is the contrast between the US central bank's actions and the rest of the world's central bank's actions. Is it possible that this disparity can really account for other currencies or bond markets suffering despite the Fed's path ahead here?
Oh, I fully think so. I've been saying that, look, the big run up in the dollar last year, I call that phase one of the US dollar wrecking ball. Phase one was driven primarily by the Fed out hawking the rest of the world, right? The Fed was the most aggressive in terms of rate hikes. And so that led to, pretty wide interest rate differentials, blah, blah, blah. And then it kind of peaked and kind of had a pretty steep correction, right? Like a 15% correction. And everybody was ready to call that the cyclical top in the dollar. And I said, hold on a second, not so fast, because now I'm starting to see this. I started saying this about a year ago, actually, saying that I could see a resurgence of the US dollar, not from the Fed out hawking the rest of the world, but from the rest of the world starting to outdove the Fed. And my view there has only been strengthened by this the four horsemen of economic resilience, right? Because like of those four horsemen, the rest of the world at best only shares half a horseman, which is like that demographic component to wage and structural inflation in essentially, the Western economies of Europe. That's it. The rest of the world does not share any of the other 3.5 horsemen, essentially. And so when you think about like the ECB's conundrum, and here's the other thing, the role of Mother Nature. Last year, Mother Nature gave Europe a total pass by giving them like the warmest winter in 40 years. And so despite all of the greenwashing of the economy there and turning off nukes, they were given a pass by Mother Nature and frankly also by North American LNG, right? Ironically. But we'll see whether or not Mother Nature gives them a second pass. My good friend Alex Dahl, who models, for instance, European gas dynamics very, very closely, showed me some work that he did recently. That if Europe has like a cold winter, they're going to go from something like 96%, storage levels currently to almost zero within like 6 months or less than 6 months. So that's another issue that the ECB is going to contend. So I contend that the mere fact that the ECB is where it is now in terms of its rate hikes is they're already struggling, right? If you look, the biggest economy in the Eurozone is Germany. Germany is already in recession, and we just printed a 4.9% pace. I mean, obviously, there's some one-off reasons for why that's not sustainable. But the point is the trajectories are so different, and the rate of monetary restrictiveness in terms of how effective it is far greater in Europe because they don't lack they don't have any of these horsemen of resilience that we have. So I really think that the next phase of the wrecking ball is going to be driven by the rest of the world outdoing the Fed.
Mm-hmm. Well, to your point, Mike, I think it's interesting to really consider that maybe Europe learned the wrong lessons from having such a fair winter for them. And of course, I've spoken with Doomberg, another one of our kind of mutual friends, about the idea of actual inventory levels and how long they can actually last. Just because they have 100% capacity or 96% capacity doesn't mean that can get them through the whole winter, right?
Yeah,
in different parts.
I think they've learned a bad lesson.
Mm-hmm.
They learned a bad lesson, they are definitely not energy self-sufficient like we are here in North America. Mm-hmm. And by the way, that's not going to last either, right? In North America, but like for now, it's a huge competitive advantage vis-a-vis the rest of the world.
Mm-hmm. Which, I mean, I spoke with David Hay a couple weeks ago, and he showed me a chart of the amount of wells that are completed, that are drilled, all of these different statistics of the oil industry. And really all of these things are really starting a real nosedive, contributing to your point of this isn't going to last forever because of this underinvestment in the North American oil, because of these very likely because of these restrictive policies from government. So, at what point do you think that really starts to bite us in the ass?
I still think we have a period. So again, a couple of months ago, I wrote I think maybe back in May, I think I wrote a thread, something like a deep dive on oil and like the supply demand singularity. And I labeled this the supply demand singularity as that scenario where the world truly runs out of spare capacity. And in that scenario, even where even a recession dented demand will exceed all available spare capacity. Unfortunately, we're nowhere near that right now, right? Mm-hmm. We're actually swimming in spare capacity right now just because of OPEC alone, I think, has probably 4 million plus barrels a day of spare capacity. And now I think the comparisons between the current environment, especially given like the events of the Middle East, and there were numerous comparisons to, oh my gosh, this is like 1973, blah blah blah. There's nothing like 1973, because in 1973, honestly, our conventional production had already been on the wane, and we really didn't know where the next molecule was coming, and we had all of these Arab countries uniting against us, right? So we really had a problem. This time around, we are still the largest producer. The Permian, you're right, every basin here has already peaked except the Permian. The Permian is still growing, but at a slower rate, right?
Mm-hmm.
And so I don't think we just, there's a lot of cushion. And then the third thing that's different is, yes, we have emptied out our SPR, which is a huge geopolitical mistake, but China has filled it. And so the frustrating thing from my standpoint, from watching geopolitics, is that one of the biggest fragilities that China has is food and energy insecurity, mm-hmm. right? And being naturally short. But we have effectively allowed them to hedge that very, very effectively at our expense, which is just utterly idiotic, in my opinion. Mm-hmm. But again, these are all sources of spare capacity in the short term. And right. So my issue, my point, I've been saying something. Another contrary opinion that I've had is that, the knee jerk on any sort of Middle East escalation is, oh my God, oil's going to go to 150, blah, 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 blah. I actually have the exact opposite view. I think the geopolitical risk is to the downside, and I'll tell you why. It's because that, traditionally, Saudi Arabia and Iran have been at loggerheads against each other, right? Mm-hmm. Especially, you see like the Houthi war in Yemen, and et cetera. And so, and you've got this weird dynamic where MBS has boxed himself into a corner where he's unilaterally supported the market with 3 million barrels per day of cuts. And so this is like his version of yield curve control. He's got no exit strategy. Mm-hmm. But you notice that recently, Saudi Arabia delegates were here in DC talking to DC. Now, what could they be talking about? My opinion is that this is an incredible opportunity for them to get some sort of security deal with the U.S. In exchange for loosening up their production, regaining market share, and then essentially protecting our flank against potentially lost Iranian production from either an escalation with Iran or renewed sanctions on Iran. Mm-hmm. So I actually think the geopolitical risk is to the downside, not to the upside. So that'll be very interesting to watch. For the most part, I've actually in my own on the short side of my portfolio, I've been, one of my put spreads is on XOP, and I've taken, so I've actually used this current geopolitical spike to uncap partially my put spreads.
Mm-hmm. Yeah, it's so interesting to try and put your finger on the pulse of the, again, those downstream effects. But one thing I want to get into with you is talking about energy, and in a way the ultimate effect on bond markets is the Japanese situation. They're such a heavy importer, and right now we're seeing, in a way, Japan kind of losing control of their bond market and the effectiveness of their yield curve control. So how does that start to really snowball and affect Japan itself?
Japan is really between a rock and a hard place. I have a couple of comments about that. One is that, during the first yield curve control tweak a couple of months ago, you remember that when they widened the range, the intervention band from 50 bips to 100 bips, mm-hmm. Within 48 hours, the Bank of Japan was out there buying JGBs again, right? So, it just showed that, and then they've got CPI printing above 4%, and they're jawboning how now is not the time to relax an easy monetary policy. Yeah, bullshit. It means that you can't, mm-hmm. right? And so this time around, what's kind of funny is that everybody expected that they were going to relax the band further to 1.5%. Instead, they basically gave this amorphous hand waving and said, we're not going to name an explicit target. But then within 24 hours, they were out there buying JGBs again. Mm-hmm. And so, before that weekend, or before that whole drama, I said, even if they raised the intervention limit to like 150 bips, is that going to make that much of a difference when the U.S. 10-year is yielding just below 5% now? So they have a big problem here, because I don't see them having a viable exit strategy. And look, see, here's the thing. I think every central bank in the world is hoping upon hope that the Fed can administer the hard medicine and inflict a global recession, so that they ultimately are let off the hook, right? And ultimately, I think they might get their wish, but the thing that's complicating it is that we have these economic factors that are making our economy much more resilient. The rest of the world, at least the ones that are mainly Europe and England, are trying. They have an inflation problem. They're trying to combat it, but they're not going to be able to keep up with the Fed. But I find it kind of funny that both the Bank of Japan and the PBOC aren't even, they don't even pretend to be worried about the inflationary issues. Well, China definitely doesn't have an inflation problem. China's been battling a deflationary problem, but Japan is definitely in this vice where they do have an inflation problem for the first time in decades, but there's nothing they can do about it. They can just hope that the Fed can create a global slowdown such that they're let off the hook.
Mm-hmm. So, Michael, I'd like to return to talking a little bit about the markets. What does the current B.O.B. or built on bullshit rally mean for three of the biggest pivot plays, as you put it, and those three being Bitcoin, gold, and silver?
Yeah, so I literally, that was very quick of you to pick that up. I just tweeted that today, and I'm like, okay, you know what? My tell, despite this huge rip roaring rally we have in equities, I'm watching for any sign that the market's kind of calling bullshit on this. And I noticed that those three, Bitcoin and gold and silver, they're kind of not buying into this, right? I mean, they've historically been like big pivot plays, and if the market is really rallying off this notion that, oh, it's no more hikes and the next thing is going to be imminent cuts, then you ought to see the dollar weaken dramatically, and you ought to see these pivot plays rip along with any high duration securities. And the fact that they're not tells me that something else is afoot. Gold right now, full disclosure, I do have actually a put position on gold that I put on recently. It's not one of my highest conviction puts, but my view is that it's after the October 6th events in the Middle East, you saw both gold and oil V bottom. Mm-hmm. And but to me, the real tell as to what the macroeconomic gravity was having on these asset classes was what happened before October 6th, because both oil and gold had nosedived. Mm-hmm. And I actually had puts on gold and had made a bunch of money on it. Then I was traveling that week and the week following after October 6th, and I didn't do a good job of monetizing and keeping my gains. So I barely got out alive of that trade. I still got out at a small profit, but didn't manage to hold on to my gains very well. So then I kind of like just stayed sidelined, but and just watched. And I in that time period, in the ensuing weeks that followed, you saw oil kind of just zigzag and kind of come back down and just stay generally volatile. Gold, I think, looks a little bit toppy to me right now, and my primary concern is that my higher for longer thesis says that we're going to have positive real rates for quite some time, and I don't think that's necessarily a friendly environment to gold. The caveat to that, I will say, is that if we really do have a loss of faith in the Fed's ability to curb inflation and wind up with like a 1982 type of situation, I can see a bull case for gold there too. So this is not I don't have a huge. My problem with gold in general is that I call it the chameleon trade. Gold, like Bitcoin, to me are greater fool trades, meaning that you are completely dependent on the greater fool for an exit strategy. And at times they are inflation hedges, at times they're deflation hedges, at times they're geopolitical hedges, which means that at other times they're none of the above. And the unfalsifiable nature of the investment thesis makes me uncomfortable because I don't really know what it is at what time.
Mm-hmm.
Or you could argue that there's something for everybody at all times. I don't know. It's a very, very complicated. What are your thoughts on that? I'd love to hear your view on that. It is Palisade's Gold Radio.
Again, I don't like to just paint myself in a corner by having gold in the title. And I really appreciate being able to get the questioning or let's say the negative side for gold. But, I think it's always different to consider it from a short-term trading perspective versus a long-term investment or preservation of value type perspective. I think we can end up kind of talking past each other based on the definition or which shoe you're trying to fit your foot into. So I think long-term, all of these tailwinds for the US economy are really interesting that you brought up here. My kind of counterpoint or where my mind goes from that is how does this debt situation end up resolving itself? And I think that's in that case is this kind of return and this worldwide drive to gold, right? We've had several quarters in a row now of record demand from central banks around the world buying gold. So, that to me is a major positive. But as you put it, there are so many times where the quote unquote fundamentals that should be good for gold, this geopolitical tension, the debt situations, all of these things should be good for it. Yet this high real rate situation should also be a real headwind for it. I think personally the relative strength that we have seen of gold not getting absolutely crushed by the higher rates is a really interesting sign. Yet we have not broken above that $2,000 range, and it ends up kind of muddying the waters, I think is the best way to put it. So ultimately, from a short-term trade, I think it's difficult to pick one way or the other. But ultimately, from a long-term capital preservation idea, I think that thesis is still intact.
So okay, so I have a couple thoughts on that, right? Mm-hmm. So again, my friend Alex Dahl has done some interesting regression analysis and on gold versus like real rates, and said that like with a pretty high R square, the sort of natural price for gold, given the current level of real rates, should be closer to 1,200. And you could argue, and I would argue that you could see the fact that gold holding where it is, you could construe that as both positive, but I would also say, I would push back and say that the negative or the bearish interpretation is that the fact that there has been all of this de-dollarization and geopolitical jockeying has perhaps elevated it to a price well beyond where the macro gravity suggests that where it should be. Mm-hmm. And if you have this situation in the dollar that I think is going to pan out, where you have this resurgence in the dollar and a shortage of the dollar, you're going to have a situation where central banks who have perhaps diversified into gold beyond U.S. treasuries are going to be faced with a very tough situation where, okay, between the price of gold that has gone up, quite a bit recently, and the price of U.S. treasuries that has gone down quite a bit recently, that is now yielding close to 5%, which reserve asset would I rather sell to shore up my own currency, right? Mm-hmm. So from my standpoint, I would rather own the cash yielding asset than a zero yielding piece of metal in the short term. Mm-hmm. So that's one argument. for the long-term sort of fiat debasement hedge, my pushback on that is that, look, fiat, it is true that fiat debases over long periods of time. It is also, I wrote a thread about this many months ago talking about something like, risk-free riskiness and Austrian pipe dreams. And in it, I was basically saying that what's interesting is if you look at GDP growth of the world going way back, centuries even, okay, it essentially looks like a flat line, and then it starts picking up exponentially around the 1850s due to the Industrial Revolution. And then after essentially Bretton Woods, and then especially after the Nixon shock in 1971, you see the untethering of fiat driven credit growth. And then you see worldwide GDP growth really kick into high gear. Now, what that says to me is that once this fiat genie has been let out of the bottle like this, and the world is addicted to fiat driven, credit driven growth, it will no longer, it is almost impossible for the world to willingly put that genie back in the bottle and go adopt a hard money an inelastic hard money standard, because that's never happened before, really, right? This mass adoption of credit driven, fiat driven credit growth. So what will force that to change? Well, it would be some major system wide reset. But see, the reason why I think that reset doesn't happen necessarily in our lifetimes is just take the Bank of Japan as the basket case, right? The Bank of Japan is both an inspiration and a conundrum to me, right? Because on the one hand, I see that they're getting to the point where they're kind of stuck between a rock and a hard place, but yet they have been arguably stuck between a rock and a hard place for like 50 years. If you look at their debt to GDP versus ours, you look at their lack of natural resources versus our ample supply of natural resources, they should have hit this Minsky moment like decades ago. And yet somehow they've been able to kick the can this far. So now you go back to the dollar, which is the U.S. The global reserve currency, and everybody's clamoring over, oh my God, this backup in U.S. Treasury yields is based signals like loss of faith in the U.S. dollar and U.S. Treasuries, and I say no, that's bullshit. That you're conflating a macroeconomic repricing of the long end of the curve with sovereign credit risk. We are nowhere near the point where the world is concerned about sovereign credit risk from the U.S.'s standpoint, in my opinion.
So what would some of the symptoms of that be?
I mean, look again, going back to Japan, right? If you look at Japan has pursued YCC for decades now, right? We haven't gone down that path, but I guess we ultimately could. I don't think it's a good idea, but we ultimately could. Well, my point is that if the long-term play for gold is a hedge against an uncontrolled debasement, uncontrolled meaning like a Weimar-style hyperinflation, well, you're going to be waiting for a long time for that, because I don't think that's going to happen in our lifetimes. And so, so then what's the alternative use? Then do you view it as a, just a store of value for gradual fiat debasement? Well, okay, but then I could tell you that there's so many other asset classes that are better. I would argue that rent producing real estate over the long term is better. I would argue that a good portfolio of stocks over the long term is better. I would argue that Birkin bags might even be better. I mean, the point is that there's no shortage of gradual debasement fiat hedges. But so what is gold? What does it represent to you? And that's always been my problem, because in every sort of domain where gold is supposed to be sort of the hedge, and by the way, I would extend these arguments to Bitcoin as well.
Mhm.
It the chameleon nature of the thesis bothers me, and to me it's very difficult to isolate. Okay, well, is it a long-term debasement hedge? Is it a short-term debasement hedge? Is it an inflation hedge? Is it a geopolitical hedge? Is it all the above? Is it none of the above? When is it what?
I was just going to say, when is it what? Yeah, exactly. And it's
Right.
interesting that, sorry, it's interesting that you bring up that point of watching the GDP of the world once we really, became untethered to that fiscal restraint that was gold. I've thought about this quite a bit as well, is trying to figure out, or sorry, thinking about the advent of debt-based credit system and the growth that has produced. It's really hard to argue in a way against the successfulness of that system until we hit the wall. And whatever that wall looks like, then I
That's it.
think we can decide whether that was worth it or not. But at
Yeah,
this point in time,
and I would
it
argue, by the way, that wall can be pushed much, much farther than anybody thinks, because again, Japan is a basket case because they, as a country, are short natural resources, right?
Mhm.
So I'm gonna put on my capital structure hat for a second and extend it to the world of sovereign credit restructuring. Okay, in a corporate restructuring, which I'm intimately familiar with,
Mhm.
what happens is that if you have an over indebted company that defaults, right? What then happens is that the debt essentially gets wiped out and it becomes equitized, right? The pool of assets that the company has becomes up for grabs to the creditors. Old equity is wiped out. The creditors wind up becoming the post reorganized equity, right? So that's basically the playbook that happens at the corporate level. So let's extend that to what would happen in a sovereign default. Well, what happens in a sovereign default, ultimately, if you're talking about a true sovereign endgame, and I wrote a thread about this, by the way, I think last year, called
Mhm.
Sovereign Endgame, something like that. Um, it's the same thing. The country that has the best sovereign assets is going to win in that game.
Mhm.
And so this is why I think from the US dollar's perspective, there is no game in town that can even compete, because the US boasts, everybody talks about the liability side of the US sovereign balance sheet
Mhm.
without talking about what's on the left side of the US balance sheet. The left side of the US balance sheet is incomparable from a geographic standpoint, from a natural resource standpoint, and then even from the soft standpoint of like rule of law and et cetera, et cetera. This was the linchpin of like the West Point paper that I collaborated on with Mike St. Pierre back
Mhm.
in February this year, was basically saying that that we have an innate strength that makes it very, very hard for any sort of top down mandate like BRICS, for instance, to try to wrest control. It makes it nearly impossible. It's almost an impregnable defense because of these innate advantages. And even if we got to that sovereign debt endgame, the U.S. still has the leg up on the rest of the world, because let's say that U.S. sovereign debt. Let's say the U.S. fast forward to, who knows, 300 years from now, the U.S. is bankrupt,
Mhm.
right? But if the U.S. is bankrupt, I'd argue the rest of the world had gone bankrupt much earlier. Okay,
Mhm.
but let's say that happened. Well, in a world where all the sovereign governments are bankrupt, and you go to like restructure the assets, and you have this global reset, again, he who has the best assets wins,
Mhm.
and it still goes to the U.S. in that case. You know what I mean? So I think the long term debasement hedge is honestly not anywhere within our lifetimes.
Yeah, that's really interesting to consider, because we hear so much of the counterpoint that it's really important to consider that the other side of it, of what the US really has going for it.
You really need to think about both sides of the balance sheet. And all of these takes that show, like, the unsustainability of the fiscal spending situation and blah 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 blah, are just considering, number one, it's a flow, a stock to flow. Debt to GDP, by the way, is a stock to flow metric, right? Debt is a measure of stock. GDP is a measure of flow. But you need to also consider stock to stock comparisons, which is why I say you need to consider the strength of the left side of the balance sheet, which none of these analyses and takes do.
And again, that's why I was really looking forward to this conversation today, because of your consideration of really these secondary and tertiary factors, really considering the entire balance sheet rather than just that one side, being focused on only that one myopic view, kind of confirming that, I hate to say, bias in one circumstance, right? So, Michael, if we go back to the kind of considering Japan at this moment, they're energy dependent on everybody else, and their bond curve is, it looks like they're starting to, in a way, lose control of it. How does that start to really affect the rest of the world, and or just the country of Japan, considering, let's say, if they get into a position where they have sold all their US treasuries, where do they go from there to be able to continue, bringing energy in from the rest of the world?
Yeah, Grant Williams and Bill Fleckenstein and I, we talked about this exact topic maybe about a year ago on a podcast, and where does it go? We're kind of in uncharted territory, I suppose. I mean, you could say on the one hand that, okay, well, because the Bank of Japan owns more than 50% of all JGBs, what if they just do like a debt jubilee where they basically just cancel the debt? Say, okay, boom, it never existed. Boom. Okay, well, in that case, right? And I talked about this recently with Guy Adami too. I think in a fictitious world where this government that just did this no longer ever needs external financing, great. Maybe they pulled the wool over the collective eyes of all its investors, and great. But in a world where this country may eventually need external financing again, the world's not going to let them do that. And I think what you will see happen in that case is you have a Weimar style implosion of the currency. I think the yen just absolutely implodes if that were to happen, right? Because of the implications on what comes next. So, and again, I mean, it's not like sovereign debt restructurings haven't happened. Again, I go back to my corporate analogy, because in the past, in past sovereign debt restructurings, you have seen situations where the owners of sovereign debt wind up getting some kind of like equity participation through like warrants on certain economic sectors, things like that. So that would be most akin to what I call post-reorg equity in a corporate bankruptcy, right? So again, that goes back to the country's national assets. And so in that situation, you're talking about a liquidation type of scenario, and Japan doesn't have a lot of good hard assets that you could restructure. You could argue maybe there's certain economic, their technological prowess and manufacturing prowess and things like that. A little bit harder to quantify in terms of what happens there in an end game. But this is it's all hypothetical. But we're kind of in uncharted territory, right? But again, but my point though, with respect to the U.S. and all the de-dollarization nonsense, is that we're so far away from that scenario. Because look at Japan. If Japan could do what they've done, the U.S. could last 5 times longer than that.
Right.
We're not talking 50 years.
Yeah.
We're talking like 150 to 200 years. So
because of the strength of the other side of their balance sheet.
Yeah, the strength of the side of the U.S. balance sheet, and not to mention all of these other levers that we have not yet pulled. Right?
Mhm.
I mean, YCC, it would be like a last option, but I would argue that we were nowhere near even needing to pull that lever.
Mhm. So
Right? I think the other issue also is just like extrapolating. I think people always like to extrapolate that. You know, you look at the unsustainability of the fiscal situation, and how interest expense is X% of the of GDP now, blah blah blah. But that
right.
presumes that interest rates stay at this level forever. Why do you assume that?
Mhm.
And then this goes back to, it kind of like ties a bow on our conversation a little bit, right? What we started with is the path, and how I think the Fed is making a mistake by dragging this out. The
Mhm.
longer they drag this out, the longer we have to pay these very, very high interest rates. If you can actually nip it in the bud and create a recession, right? Hopefully, we can get back to a regime of lower rates. Maybe not ZERP. I don't.
Mhm.
I honestly think that maybe the days of ZERP are gone, because there are some structural factors that'll keep it from going there. But maybe we don't need to be at 5.5 or even 6%.
Mhm.
Or maybe that R star is 3%, or so.
Yeah, really, really accepting a higher known target.
Right.
One of the pieces that I'd like to get your take on that we really didn't mention is the effect of the demographics. Japan is an aging population, and I've heard different takes on it. Basically that they can, in some ways, different countries can export the demographic problem to be able to export part of their manufacturing base, right? So how do you
Mm-hmm.
think that starts to play in?
Well, that's interesting. That's actually something that Peter Zihan has covered very well, right? And he would argue that how Japan has dealt with its demographic issue is exactly that, right? They've essentially outsourced their manufacturing base, essentially have, like, say, Toyota plants here in the U.S. And then of course you've got like the whole automation argument, robotics, blah blah blah. But I would argue that let's shift the conversation to China for a second, right?
Mm-hmm.
And China's experiencing the biggest demographic bust of any major modern country. And how do they get out of it? And people invariably point to, okay, well, they could do what Japan did. There's automation, et cetera. But number one, their population is so much bigger that they cannot easily do what Japan did. Okay.
Mm-hmm.
But as Peter Zihan put it eloquently in this event that I chaired, where he was the keynote, he basically said, even if they solve the labor productivity issue, right, with robotics, let's say,
Mm-hmm.
it doesn't solve the entire other half of the equation. The robots consume, right? So like, China is really trying to change from like a investment growth, government led economic model to a consumer based model. Well,
Mm-hmm.
good luck with that if your population is going to get halved in like 30 years. How does that happen? You know? So,
Yeah, it really, again, it really makes you try to take the entire picture into consideration. And it's interesting to consider as well how much China really produces, and if they're going to be able to have the ability to export that production capacity just because of the sheer size of it, right? It's not necessarily like we can, sprinkle a little bit here and a little bit there and
right,
into these
right.
different countries. This is a massive, massive production base that.
And China is a big. I think China is experiencing a big problem,
Mhm.
because there was a great Odd Lots podcast a while ago with Richard Koo, who was talking about the Japanification of China, right?
Mhm.
Except that the thing that stuck out in my mind is that Japan had this balance sheet recession that was precipitated by their property bust in 1990,
Mhm.
but then their demographics peaked like 30 years later, right? Well, in China's case, the demographics peaked the same time that Evergrande blew up, which is a couple of years ago now,
Mhm.
right? So now you have you have a short-term cyclical bust coinciding with a long-term structural bust. And that's, in engineering parlance, we call that constructive interference, where you've got like, two signals buttressing one another and augmenting one another, in this case to the downside.
Right. Absolutely. Michael, I want to thank you for a really thoughtful and interesting conversation that
we went down some interesting corridors today.
Absolutely. I really appreciate getting to do that with you, because that's where I think the real value in these conversations come from, right? It's not necessarily considering what should be, but we're trying to account for what is and the reasons that we're having the consequences that we are right now. And I mean, just in the demographics issue, it's always an interesting kind of wrench in the gears of thinking about, I've had, I think, Andy from Finding Value Finance that provided the explanation that it wasn't necessarily Volcker that killed inflation, but it was the demographics side that actually killed it. So it's always interesting to consider that piece of the puzzle and how it fits into all these different scenarios.
Well, from that standpoint, then Peter Zeihan has also done some interesting work, because from a demographic standpoint, he would argue that we are in a structurally inflationary period until essentially the kids of the millennials, I think that's called the Zoomer generation, essentially wind up joining the labor force. And unfortunately for us, that's not for like another 15 years. So
and I believe that those rates aren't, very able to replace the outgoing side of that workforce either.
I think I have to refresh my notes, but I think he thought that eventually it'll happen, but we're going to be in a structurally inflationary period for potentially 15 years from that standpoint. So, that's a very interesting potential fly in the ointment, right? So like maybe like what my prescription of like the Fed sledgehammering the economy into submission, maybe that doesn't even work. Right. Because
you have this lack of supply from all sides, whether it's labor, whether it's energy, everything.
Right.
Yeah. Excellent, Michael. Well, of course, you're available on Twitter at Urban Cowboy, Kaoboy, and urbancowboy.com, where you have all of the links to your Substack and everything, right?
Yes, sir. Thank you for having me. Great question.
Thank you, Mike. I really appreciate the very thoughtful conversation and making me think and consider all of these different different
vice versa.
Excellent.
Vice versa.
Thanks, Michael.
Great. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.